Welcome to SectorExchange.com. I'm Jim Farish, founder and editor. As we've been talking about the learn how to use SectorExchange.com in each of these videos, we've tried to really explain in an overall format what the theory is really behind the website and why and how it works. I think sometimes I know I'm guilty of going on websites. I don't have a clue, can't really follow what people are thinking. But when you look at this website, I tried to make it intuitive enough to follow along. But what we're going to look at right now is sector model portfolios. And when you look at the sector model portfolios, these were really built as models. Originally, we didn't have models on the website. When we launched this back in 2001, and a lot of people didn't want just research without some type of a model or a portfolio, so we built the models. And what we have done is evolved the website from the standpoint that what you get is all the research on Sector Watch, which is a video you can watch here on Learn How, which is all the research. It's the part that, for me, is the lifeblood of what we do on a day-to-day basis as both an investor, a professional advisor, and as a publisher on this website is the research. And then what we do is try to take the research and take it to the next step. The reason I've acquiesced on developing the models is that it really gives me a chance to teach trading. And that, I think, is one of the most valuable components of this, is teaching you how to manage positions. Because if you manage positions, you'll manage your portfolio. For a long time as a portfolio manager, one of the things I used to do in my professional advisory business was we always tried to tell people that it's more about the portfolio than the positions of the portfolio. So don't, throw the baby out with the bathwater, so to speak. And as 2001 and 2 started to evolve, we started to understand that really entire portfolio is going to go bad quickly when the markets go against you. We saw that again in 2007 and 8 as the markets retrenched back over the financial issues that face this country. But when you look at the fact that you have cataclysmic events and that they are real, managing positions keeps you out of trouble with your portfolio, and it takes positions out of the portfolio and it raises cash to buffer against any cataclysmic event that you'll get. So my view of portfolio management has shifted more and more with time to be more position management. And then by managing the positions, we actually learn how to manage portfolios. So let's go to the sector rotator model. I want to talk about both of these models, how they're designed, what the theory behind them is, and how they work. So when you go to the sector rotator model page right here off of the title bar, you'll come down and there's two tables. One is a watch list, and the second is a model portfolio. And the watch list, unfortunately, on this one only has one position on it right now. But when you look at this, there could be 10 on here. There could be 5. There could be 2 or 1 like there is at this point. And there's no magic to how many reside on the list. In other words, when we run the scans and we run and filter over the weekend coming into the trading week, what we're looking at going forward, we're going to add what works and what doesn't work. It will reside or stay on the watch list until which point in time it either validates itself and goes into the model, or it invalidates itself and we just throw it off the list altogether. Remember on one of the other videos that I said we have our belief, in other words, what we think will happen. That belief is our watch list, if you will. And so whatever I believe is valid, I will put on the watch list. Now, there's some things that will never make it out of the research page, and I didn't cover this on the research page, but when you're on the sector watch page, there are things there that are tradable that will not actually ever make it to our watch list. That doesn't preclude you from trading them. That doesn't mean you don't see things that you can't trade. Let's say, for an example, the Qs with the NASDAQ 100, if it's moving up and you want to own the NASDAQ 100, let's just go to a chart here real quick and look at how this would play out. And let's type in here NDX, which is the NASDAQ 100 index. And if we were to look at the NASDAQ 100 here, you can see the downtrending line. So let's build a trade. Obviously, we can see things looking backwards off of this chart, but you can see, and we did, this is actually a position that we did take, is you can see this consolidation triangle or wedge, whatever you want to call it, and it really was consolidating. And what we looked at is, can we get a break to the upside? Well, we did get the break. You can see the gap breakout there, and that was off of the earnings coming into January timeframe. So we get a gap higher as we start the new year, and as it starts to evolve higher, now we got to manage the position, and that's what I'm talking about. That's what the portfolios do. But let's say that I put it on here and I never really added it to the watch list. You can see that as well as I can, and you can see the breakout as well as I can, and you can see where your entry, exit, and target may also be relative to that. And many times in the notes, I'll even say, I'm not going to take the trade, but if I were, here's where the breakout would be above this point. Here's where the entry is. Here's where the exit would be, or a stop. And here's where the target is, and how to manage money. So we'll actually talk about how we do that. But off of the watch list, you're going to derive opportunities that don't necessarily make it into the portfolio or the model. And that's really, I think, an added plus to the website, is that we do look at everything. It's just whether or not we think the risk of the trade is too great to take relative to the model discipline. And the discipline of this model is really very simple. The discipline of the model is designed to make 1% per month and not lose money. In other words, if we said, I want to make 1% a month and not lose money, that means I'm going to make 12% over the year, but I don't lose money year after year after year after year. You don't have to be a rocket scientist to compound the rate of return on a portfolio that can consistently compound out at 1% a month. Now, that doesn't mean it's always going to happen. Doesn't mean that we don't lose money. I would never be so naive or egotistical to say that that's true, but what it does is it creates a discipline to the portfolio, and it creates a discipline by this measure. As you can see here, most of these positions were added in January, portfolio up 1.4%, and so we've achieved the 1% for the month. And the question to me is, stepping back away, how I think into this process is, how much risk do I have? If I have elevating risk, then I want to tighten my stops. And that's where you see the yellow highlighted boxes are where we've tightened the stops. That's where we push stops higher to protect principal and or to protect profit and or not to avoid further losses on the downside, which you can see ONN right there. The stop was 860, meaning we raised the stop from where it was, and it had, because it had moved back below our entry point, wasn't acting very well. And what we started to look at was, do we want to tighten up what our actual downside exposure is, which is what we did. On the opposite side of that, we raised our stop on MOO, which is the Ag Businesses ETF, to a break even, meaning that if this started to pull back, worst case scenario is we get out at a break even. And you can see over here the time frame. So if I'm trading, I'm 0 to 13 weeks is what I'm looking at as a time horizon. Short term, 13 weeks to 9 months. And so we look at, evaluate, and tighten based on what we see going on relative to the markets every day. So our discipline is built into this to manage the risk day to day, week to week, month to month. So we're always looking at, how do we manage the portfolio to capture a 1% gain and not lose money. And if I went back and looked at what this model has done, which you can do, by the way, for the period of time that we've been tracking this model, you can actually go into the model and look at right here, archive trades that are on the model, and they'll come up in a box just like that, and you can see actually what it's done for that period of time. And you can see all the trades. This is put up here not for performance, but so you can actually see trades and how they develop, how the, not all, you can see there's negative numbers there as well as positive numbers. The focus is to limit the downside risk, maximize the upside gain, which is what everybody wants to do. And that's as simple as it gets. That's how we build it. So to put this back, let's go back and look at how would you use this page as a subscriber. When you come to this page, you can come to it every day. It's updated every day. You're going to see Bank of America. You'll see the symbol, the date that we posted it, what the closing price is, the rating, which is watch, buy, or hold. And, it really is just that simple. We're watching it. The entry price that we're looking to buy it, the stop price where we would actually sell it if it actually started to move lower, the target price or what we're looking to make from the position, the time frame, and the model allocation by percent. So what we're doing is we're actually managing money. We're doing it from the standpoint of how do we manage every position. That's why each night on the update, on the sector watch page, when we do the video update, we actually go in and look at all of the positions. We actually talk about what's happening. If there's something that we need to look at, example being on the model down here, if we raise the stops, we're going to address why we raised the stops. In other words, why did I raise it to $8.60? We'll show the chart. We'll explain why we did it. If it's protecting gains, like on the DVY right here, we got it up at 53.75. You can see that entry point was 53.10, closed at 54.03. We're looking to protect erosion. In other words, if we looked at the chart of this, we would see that DVY was starting to roll over and we're starting to ratchet it up. You say, well, you only got a 1.75% gain on the position and it was a short term. So you were actually looking longer term. You just bought it. Why are you worried about it? Well, at the recording of this, we actually been in this almost 5 weeks. And what we're starting to see was some weakness in the broader market. And as that weakness crept into the market, what we wanted to do was protect any losses against the portfolio. You do not have to have your stops at the same point. We're just giving you, based on our discipline, what we're managing and how we see it, how we're going to do that. You can say, oh, well, I'd rather have my stop at 53.10. That's a break even. I'm good with that. And I want to hold this longer term. And you can override anything you want. That's the point of this. This is research driven by us. We post it and we track it every day. You have a brain. It's hopefully it's lodged between the two things that stick out on the side of your head there, and you use that every day to manage your money. So that's how we manage the portfolio. The watch list. This gets into how people trade, and without trying to tell you how to trade, when I post that the entry's at $7.40, I'm going to look at pre-market. Where is Bank of America? Is it at a point that I want to, is it going to gap above the entry price? If so, I want to wait for it to come back. I can use buy stop orders. I can use buy stop limit orders, but you will be able to get into these positions based on how you trade. If you're trading or watching this throughout the day, you have an advantage, I believe, over someone who's not watching it every day. And the reason I say that is that you're more active at the management of it, and you can manage more and more of the market cycles. But in the same tone, you are at a disadvantage because you have more emotions, because you are looking at it. And believe it or not, that could be more detrimental than not. Sometimes we need to place our trades and go play golf and let the market do what it's going to do day to day, intraday, instead of always trying to say, oh, I got this figured out, because sometimes you don't necessarily have it figured out and you become a raging neurotic based on how you trade. So the short and simple of that is get into the trades defined, and we're going to cover this in another one of the Learn How To videos on entry, exit, and target. Manage those entries, manage the stops, and manage the targets, and treat them with discipline and not just as arbitrary points. Too many people I talk to around the country too often, I'll ask, do you use stops? No, I don't like stops because the market makers steal stock from me. And there, I understand that feeling. I have it at least once a day, probably. But, from a realistic standpoint, I don't think they're sitting around looking for your trade. But I do think that they are looking for a bunch of trades at those prices. But you have to look at the fact that how do you trade day to day? And if you're not a good person with emotions watching it, then don't do it. So the models are built that way. So that's the sector rotator model. The sector income model is very similar in the fact that it looks at all the sectors, it filters through, it does the same thing with the research. The difference is we're focusing on income. We're focusing on how do we derive income from the portfolio, and that's generally going to be dividend driven, but it also could be through trading. So, you don't necessarily just generate income by a dividend, but that's the theme essentially of the model it is income driven. So where are you going to look for income? Dividends. And so we've built a filtering or scanning list that really is focused on that. It focuses on whether or not we can get dividends. And you can see here on this current watch table, high yield bonds and REITs were two of the positions that we were looking at. We did enter both of those positions, which you can see the rating is in play. And by the way, I didn't cover this on the other table, but there's a note underneath each of these on the watch list, which kind of defines what I'm looking at, which you can read here. High yield bonds will benefit from the rally in stocks. The move through resistance is a good entry point for the ETF. The dividend yield is currently 7.4% for the entry price. So we were looking to capture that dividend, and we were looking for a 13-week to 9-month holding period. In order to capture that, most of these plays, we do look for growth and dividends. So we're looking for a little bit of both or a combination of the two, and that's how they're built. So VNQ, you can see the dividend yield on that was 3.5%. Allocations to the model, 10%. And then you can see that they were entered down here, and for whatever reason, the price is not updating. But when we look at this, it'll just basically, you can see there's the dividend at 3.4%. What's working, what's not working. There is really the key to me is how does that filter down to you as an investor, is that we're looking for income, and how can we derive this off of the income for what we want. So you would get a closing price there, the entry price. It would tell you what the profit and loss is by position. And we can see up here that VNQ is at 61.68. We bought it at 58.85, which means that we've made 4.5 to 5%. What does that mean? Now you want to manage the position is what you want to do. You bought it with a 3.5% dividend yield. You've already captured more than the 12-month dividend yield in appreciation. So what we do is now go in and manage that risk by ratcheting up the stops, which you can see that we've already done, and that we're locking in a profit, worst case scenario on that. And that is how you manage an income portfolio, is you're constantly looking. Now, what's the basis or premise of this is that we're looking for a 8% total return per year, which means that if you break that down, it's about 0.7% per month is what we're looking for, and the dividend and combination of growth. And that's what we look at. This is a model that we've been running in our advisory firm for many years. It's one we just actually launched onto the website in 2012 because of a demand or ask for it. Sector Exchange website was really designed as a growth portfolio because people have said, look, I'm retired. I'm having a hard time finding dividends, having a hard time finding income. We decided we should launch an income model, which is exactly what we did. So you have both models there to choose from, so you get more bang for your buck. And thus why the website is $995 a year is you get a lot of information. You get two different models that you can trade off of and invest off of, and that, I think, is very valuable as an investor on a day-to-day basis. So basically what we see on the website is that you've got both models to attach to. You can see we do our research, we put it into the models, and we define the models, we track them, we watch them, and we update them every day. And that's really the meat of what SectorExchange.com is all about.